Hey guys, hope you're doing well out there. It's time to check in on the story of Alibaba Group Holdings, as you have shares down nearly 6% on the day after reporting their Q4 results earlier in the morning. And so you're trimming into those year-to-date gains of 9% and of course extending your 1-year and 5-year losses of nearly 50%. And as we walk through today's results, you'll see there's still some things to like about this name, namely their forward price to earnings multiple trading now underneath 8-10 times. You also get a dividend on this one close to 1.18%, so you have a reason to at least hold on to it for some amount of time. You're also getting a large amount of buybacks with a stock like Alibaba, and so with a market cap now south of $200 billion, you're getting a fair amount of buybacks. Now, with things to like, there's also a lot of things to not like about this stock, apart from just your overall geopolitical overhang, which keeps a lot of people, including me, out of this name. You also have the fact that this company, as it scales larger and larger, is actually becoming less efficient instead of more, and we'll see that in their numbers. Now, Q4 revenues came in at $30.73 billion. That was good for 7% growth year over year, did beat estimates by $310 million. As we look ahead for Alibaba, you see that they're really pegged at that mid-single digit growth, somewhere between, call it 4% up to 6% for the upcoming fiscal year. Keep in mind, this was Alibaba's Q4, so bit on a wonky fiscal calendar year, and their largest holiday quarter comes in their fiscal Q3, and that is the December quarter for them, expected to do close to $39 billion in revenue. And you see this company, despite doing a relatively large amount in revenues, continuing to grow at least on that mid-single digits, really keeping up just a little bit ahead of inflation. That's something to like. But as we see, Q4 non-GAAP earnings per American depository share, otherwise known as ADS, came in at $1.40. Not only did that miss estimates by roughly 2 cents on Wall Street, that was actually a decline year over year. And as you see, this company on their earnings side is expected to decline their earnings close to 13.5% in their upcoming Q1. On top of that, declining earnings by roughly 8% for Q2, and then flat year over year earnings for Q3. And so you see, despite this company growing their revenues, call it in the 4 to 5 to even 6%, they're expected to decline on those earnings year over year, call it basically into the upcoming year. And so that really shows me, as this company continues to scale on their revenues, they're actually losing operating leverage and becoming less efficient instead of more. Really, we see their counterparts here in North America. You have a company like Amazon or Google, even Microsoft. As they continue to gain revenues, they're continuing to increase their earnings at a faster clip, showing that they're becoming more efficient instead of less. Now, in terms of the different segments, we have the total Taobao and Tmall group. This is still, believe it or not, the bread and butter over at Alibaba, generating roughly $12.9 billion in US revenues. That accounts for roughly, call it about half of their $30.7 billion of total revenues. That grew at just 4%. So again, not bad for how big this business is, but keep in mind, just essentially keeping up with inflation when you account for that. On top of that, their cloud business, this is all important over at Alibaba, similar to how AWS and Azure is important for Microsoft and Amazon. And so you have roughly $3.5 billion on this cloud group, but that just grew at 3%. Again, we compare it to AWS and Azure, which are growing in the double digits at least. And so Alibaba Cloud growing at just 3%, simply not good enough. And that's part of the reason why this company simply can't, in my opinion at least, demand the same multiple that you get with those companies in the US. And Alibaba actually did mention that the cost benefits from their infrastructure scale and advanced technologies enable them to reduce prices across their more than 100 public cloud products. And so this tells me that either this company is becoming too large, recognize those efficiencies, or the fact that the Chinese government simply has too large of a hold on this company and is really forcing them to reduce prices instead of actually raising prices and realizing those cost benefits to the company. I think China really wants public cloud adoption to be mainstream. And look, overall, this is probably a good thing for the Chinese economy, probably a good thing for their vendors, and keeping the Chinese market competitive, at least on their cloud business. And I think that's really the ultimate aim for the Chinese government. But what that does is hurt a company like Alibaba, which, instead of recognizing those cost benefits to the company and to their shareholders, they actually have to price those down and pass those on to their customers. Again, good for their customers, but proving to be bad for Alibaba, as they're simply able to grow their cloud revenues at just 3%. As we look at their international e-commerce business, that came in at $3.8 billion. Again, this is on a US dollar basis. Still growth of 45%. So at least that business continuing to grow extremely rapidly. But I do want to point out, on $3.8 billion worth of top line revenue, you still lost nearly $500 million in operating income. And in fact, your losses accelerated on that business by close to 88%. So like we said, as this company gets larger and gets more revenues, they're actually seeming to become less efficient instead of more. And so while this 45% growth on their e-commerce business certainly helps their overall revenues grow favorably at 7%, losing more money by close to $500 million on that business certainly proving to be challenging, at least from an operating basis over at Alibaba. And it gets worse as they have their logistics and local services group, again, continuing to grow at a rapid clip of 30% and 19% respectively, adding to your total 7% growth on that revenue side. But you're still losing nearly $200 million on your logistics network and close to $500 million on your local services group, again, accelerating those operating income losses year over year. And so off of $30.7 billion in total revenue, you're generating roughly $2 billion in operating income. And so that gives you a operating margin of less than 10%, in fact, closer to 7%. And so despite gaining nearly 7% on your revenues, you lost nearly 3% on your operating incomes, really proving that point that this company becoming less efficient the larger it gets. Now, either you can blame that on the size of the company, or in my opinion, I would put it on the fact that the Chinese government simply has a hold on making this company far more competitive in the market rather than using their scale and infrastructure to boost profitability over at Alibaba. So that's really your bear case over at this company. As you gain on your revenues, you're continuing to lose on your earnings, and on top of that, you're also continuing to lose on operating margins. But along with that, you do have a bull case over at Alibaba, and that is based on a couple of things. So the first one is the fact that this company continuing to buy back just a boatload of their common stock, reducing those shares outstanding. In this most recent quarter, Alibaba bought back nearly $5 billion worth of their common stock, reducing shares outstanding by 2.6%. That's over the last 3 months. Over the last 12 months, they've bought back close to $12.5 billion, reducing 5% of their shares outstanding. And keep in mind, this is still a company with a large buyback in place. I believe somewhere close to $15 or $20 billion left on their buyback through next year. And so this company continuing to do those share repurchases, reducing those shares outstanding, one of the reasons why their EPS doesn't decline nearly as fast as it should on at least an organic basis. The other bull case over at this company is the fact that you have a dividend. Alibaba announced this recently, and they're continuing with their dollar on their American depository shares. That comes out to roughly 1.8% on an annualized basis. Now, Alibaba also announcing a one-time special dividend of 66 cents per American share. That is due to them divesting and disposing of certain parts of their business. And so they're at least spitting out that part to you, the shareholder, in the form of a one-time special dividend, and that you can expect to recognize somewhere in June or July. And so the bull case over this company is the fact that you're reducing your shares outstanding by nearly 5% on a year-over-year basis, and the fact that you get a dividend that, in my opinion, is probably largely extremely safe and one that can continue to grow. The other bull case over at this company you're making is from a valuation perspective. You see, this is on a trailing 12-month basis. This company generated $8.62 on a non-GAAP earnings basis for the full year, trading at now south of $80 on a share price. Yeah, you're paying less than 10 times a trailing 12-month earnings on this company. Keep in mind, you expect earnings to stay roughly flat on the year. And so even on a forward basis, you're paying close to 10 times an earnings multiple. Certainly not expensive. But as we saw, one, I think that doesn't deserve a high multiple simply because the growth and the efficiencies aren't there over at this business. On top of that, this is just a free cash flow generating machine, as you generated nearly $21.6 billion over the course of the past 12 months in free cash flow. And that is what allows this company to do just large amounts of buybacks, and now allows them to pay that dividend. Over 12 months, you're doing nearly $22 billion in free cash flow. And lastly, your last bull case over at Alibaba is based on your balance sheet. This is a company, call it close to $85 billion in cash, short-term investments, and other securities. And you balance that out with roughly $90 billion in total liabilities. So you have nearly more cash and short-term investments than all total liabilities. So extremely well capitalized, in a tremendous position to not just continue to do those share buybacks, but accelerate those and continue to accelerate your dividends over at Alibaba. This is also a company that's continuing to invest heavily in their AI and infrastructure. And so it does see a relatively high amount of capex on that, but keep in mind the benefits on things like AI and infrastructure simply won't be recognized over at a company like it would over at, let's say, Amazon or Microsoft, because this company can't simply just go up on prices when demand is high. They have to pass those cost benefits down to their vendors and customers instead of realizing themselves. Now, from a chart perspective, you do have some things to like, not a whole lot, but still we can find the good in this technical pattern. You have the large decline, call it back from 2020, where a lot of people likely got burned in a name like this. And it seems like over the past, call it 1 year, this company is showing signs that it wants to settle out and wants to form a bottom. Now, what you want to see with this company is a decisive break above your resistance line, call it smack dab at $80 a share. Coming into these earnings, Alibaba was closer to $85. What you wanted to see was a decisive break higher, call it near $90 a share. What you got instead was a break lower, once again underneath your support at $80. So what I see next for Alibaba is this one coming somewhere between your 70s up to your $80 a share. I expect this one to continue to chop sideways. Now, if you are accumulating shares of Baba at this point, what you want to see is this one come down, call it somewhere in the $75 a share, and then bounce back from there to form your first set of higher lows. You made a set of lows back here in April, and what you want to see is this one make your first set of higher lows to confirm the start of an uptrend. That is really what you want to see with Baba, and then you want to see a decisive breakout above these highs, call it at $90 a share. This is not one I would continue to buy and hold, simply because of the fact you have a lot of people still stuck in this name. I'd say somewhere between $90 up to $120. And as this one comes in and pokes its head above, you'll have those ones likely sell off their shares and put selling pressure on this one as it continues to head higher. And so if you are picking up, let's say 10 shares of Alibaba somewhere in the 70s, and you want to build a sizable position in this, I would take my profits as it continues to move up, call it in the 90s or the 100s, shave off, maybe not all of your shares, but you could shave off, call it half of your position, and lock in those gains. Certainly, if you have the stomach to hold on to a name like this, at least on a swing trade, at least through a set of higher highs and higher lows, yeah, it could be a possibly winning trade. But in my opinion, I think there's just too much uncertainty with a name like this, not just from your overall geopolitical China risk, but the fact that this company simply not churning out enough operating income despite growing its revenues. I think you have better counterparts for Alibaba here in the US, namely Amazon, Microsoft, and Google, and simply you can get enough capital appreciation on them without the same outsized risk that you get with a name like Alibaba. That was my take on shares of Alibaba, not one I'm interested in, despite a cheap valuation, despite that dividend, and despite a consistent set of buybacks. You simply have too much uncertainty with this one. Let me know your thoughts with shares of Alibaba in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.